In November 2021, Alex Mashinsky stood before 1.7 million customers controlling $28 billion in cryptocurrency. He promised them 18% returns while wearing a t-shirt that said, "Banks are not your friends." 7 months later, he froze every single account. Billions trapped. No withdrawals, no timeline. Prosecutors later called it one of the largest cryptocurrency frauds in history. The man who promised to replace banks became exactly what he claimed to hate. But how did so many smart people fall for it? Alex Mashinsky wasn't some random crypto bro. This was a 52-year-old serial entrepreneur who claimed he invented voice-over internet protocol technology. The guy who said he thought of cryptocurrency before Bitcoin even existed. He had credentials. He had experience. And in 2017, he had a pitch that sounded revolutionary. The pitch was simple. Deposit your Bitcoin or Ethereum into Celsius network. Earn up to 18.6% interest per year. Your bank pays you 0.5% on savings. Celsius pays you 18, no fees. Weekly payments. Just download an app and watch your crypto grow. The business model made sense on paper. Celsius would lend your deposits to big institutional borrowers, make profit, and return 80% of those profits to you. Everyone wins. Banks lose. Mashinsky called it unbanking yourself. He hosted weekly YouTube live streams called Ask Mashinsky Anything. He wore those anti-bank t-shirts like a uniform. He even tried vandalizing Chase Bank branches as publicity stunts. People loved it. The guy was relatable. He answered questions live. He seemed transparent. He wasn't some Wall Street suit hiding behind lawyers. He was one of us fighting the system. The growth was explosive. In November 2020, Celsius managed $2.2 billion in assets. 1 year later, $28.6 billion. Nearly 1.7 million users worldwide trusted him with their life savings. The company hit a $3.5 billion valuation. Silicon Valley investors poured money in. Celebrities promoted it. Your friends told you about it. The fear of missing out was real. Nobody questioned the math because the payments kept coming. Every single week, interest hit your account. You could see it, you could spend it. If it was fake, how were they paying everyone? That weekly proof became the ultimate marketing tool. Old customers recruited new customers who recruited more customers. The machine kept growing. $28 billion worth of trust. But behind the scenes, something was very wrong. And the people inside Celsius knew it. Here's what nobody outside Celsius knew. The company had no written risk management policy until 2021. Think about that. A platform holding billions in customer money had no formal plan for managing risk for 4 years. But it gets worse. The interest payments were a lie. Celsius was paying out more money than it was earning. Negative net interest margins is the technical term. The simple version? They were borrowing from Peter to pay Paul. New customer deposits funded the yields to existing customers. Sound familiar? It's the same playbook Bernie Madoff used. It works perfectly until new money stops coming in. Internal messages tell the real story. Celsius employees called their own CEL token worthless. They said the price should be zero. While staff wrote this in private Slack channels, Mashinsky promoted CEL publicly as a revolutionary investment. Why the split between public lies and private truth? Because CLL was the heart of the scam. Celsius created its own cryptocurrency token and convinced customers to hold it for better rewards. Then they used customer deposits to artificially inflate the price. Undisclosed buybacks made CEL surge 14,751% between March 2020 and June 2022. Celsius was essentially the only major buyer of its own token, creating fake demand with your money. While the price climbed, Mashinsky secretly sold $68.7 million worth of CEL tokens over the years. Prosecutors later proved he structured these sales specifically to manipulate the market and trick others into buying. He pumped the price with customer funds, then dumped his personal holdings at the peak. Classic pump and dump, but with billions at stake. The reckless gambling made everything worse. Celsius lent over $1 billion to a crypto hedge fund called 3 Arrows Capital. no proper collateral. When Three Arrows collapsed in May 2022, that billion vanished. Celsius also threw customer money into risky yield farming schemes and locked funds in illiquid long-term investments while promising customers instant withdrawals. The house of cards was obvious to anyone who looked, but nobody was looking closely. Until the market crashed. May 2022, the Terra and Luna cryptocurrencies imploded, triggering panic across crypto markets. Prices cratered. Investors rushed to pull money from risky platforms. Celsius customers started withdrawing fast, too fast. Mashinsky made a move. He quietly pulled $10 million from his own Celsius account. Called it tax payments. Perfectly legal, he said. But the timing was interesting. Customers were panicking, and the CEO was cashing out. Then came the internal data. Bankruptcy examiners would later review 500 gigabytes of evidence, 231,000 documents, Slack messages, emails, financial records. The picture was damning. Celsius had been operating with a massive balance sheet hole for months, maybe longer. The money simply wasn't there. On June 12, 2022, Celsius froze everything. Every withdrawal, every swap, every transfer. If you had money on the platform, it was trapped. No warning, no timeline. Just a vague statement about extreme market conditions. 1.7 million people went to bed with access to their savings and woke up locked out. Social media exploded. Reddit threads filled with horror stories. People had their entire net worth stuck. College funds, retirement savings, money for medical bills, all frozen. And Mashinsky went silent. No more weekly live streams. No more Ask Mashinsky Anything. The man who built his brand on transparency vanished. The lawsuits started immediately. Other crypto platforms sued Celsius for market manipulation. Regulators opened investigations. Journalists dug into the records, and the truth started pouring out. July 13, 2022, Celsius filed for bankruptcy. Chapter 11. The documents revealed a $1.2 billion hole in the balance sheet. Later estimates put the real losses at $7 billion. The arrest came a year later. July 2023, federal prosecutors charged Mashinsky with 7 counts, including securities fraud, commodities fraud, and market manipulation. The SEC, FTC, and CFTC all filed civil charges. He was banned from ever handling consumer assets again. The evidence was overwhelming. Prosecutors had the Slack messages where employees called CELL worthless. They had the blockchain records showing Mashinsky's secret token sales. They had the bankruptcy examiner's report laying out years of fraud. There was no defense. December 2024. Mashinsky pleaded guilty to 2 counts. May 2025. A judge sentenced him to 12 years in federal prison. Not 12 months. 12 years. He'll be in his 70s when he gets out. Meanwhile, the victims wait. Most Celsius creditors are receiving only partial recovery through bankruptcy proceedings. Some will get back 30 cents on the dollar. Many will get less. Life savings gone. Retirement plans destroyed. Families bankrupted. All because they believed a man in an anti-bank t-shirt. 4 rules that could have saved you from Celsius. First, impossible returns are impossible. 18% when banks pay 0.5 should trigger immediate skepticism. Basic economics says high returns require high risk or high fraud. There's no middle ground. If someone promises you free lunch, they're serving you poison. Historical stock market returns average 10%. Anything double that without proportional risk? Walk away. Second, demand transparency. Celsius had no audited financial statements for years, no clear explanation of how they generated returns. Just trust us, they said. Here's the rule. If a platform won't show you the books, assume they're cooking them. Require third-party audits. Verified proof of reserves. Regulatory compliance. If they deflect or give vague answers, that's your answer. Third, watch what leaders do, not what they say. Mashinsky preached holding crypto while secretly selling 68 million in tokens. He withdrew 10 million weeks before freezing your accounts. When the captain abandons ship, you should too, even if he's still wearing the uniform. Track insider transactions. Monitor founder wallets. If executives are selling aggressively, they know something you don't. Fourth, diversification is insurance against fraud. Even sophisticated investors lost everything because they concentrated holdings on one platform. Never put more than 5 to 10% of your portfolio in any single investment or platform. Spread across different assets, different platforms, different countries. Fraud is often invisible until it's too late. Celsius looked legitimate right up until it wasn't. Structure your portfolio so no single failure destroys you. The most dangerous investments are always the ones everyone believes are safe. Celsius had 1.7 million believers. They were all wrong. Every week, another billion-dollar fraud gets exposed. Subscribe so you don't miss the next fall from grace. Next up, how FTX collapsed just months after Celsius using almost identical tactics. And if you spotted even one of these red flags before the crowd did, drop a like. The next Celsius is already out there. Let's find it before it finds you.